announcing the winner shortly. Thanks for tuning in, and without further ado, Andrew, welcome. The mic is yours.
Thank you, Abby, and appreciate the opportunity to be with E4 on this brew this afternoon. So, again, thank you for the opportunity, and appreciate all of you advisors taking time out of your busy schedule to join us today. So, I got to say, Abby, I think I like the milometer. I think you said I think I prefer that name over odometer, although I doubt that would translate very well over to the metric system. As Abby mentioned, I'm joining you all today to kind of give an industry update. Specifically, I'm going to talk about just a few items. Some regulatory changes that you may or may not have heard of, specific to the life insurance industry. I also want to go over kind of the current environment as it relates to regulation. And then lastly, I do want to close up with just some opportunities that I think are some great planning opportunities for 2021. And keep in mind, this is going to be pretty brief. Got a couple of minutes with you today, so I think of this as more of an appetizer. My thought today is to just give you some ideas about what's going on in the industry, some changes, some opportunities. But my hope is that after today, you've got some questions, and you can follow up with E4, who can help you with that. As I mentioned, I'm going to start talking today about 7702. So some of you may have heard about the regulatory changes with 7702, specifically, the life insurance changes. How does it impact cash value life insurance? And that's what I want to highlight again today. What you're seeing here on the screen is the 7702 changes as they are today and what they were previously. What this is affecting is the interest rate that life insurance carriers are using built inside cash value life insurance. So for example, here, the cash value accumulation test, so CVAT as we commonly refer to, the prior rule under 7702 was that life insurance carriers would use a 4% assumed interest rate. And you can see for Guideline single premium, Guideline level premium, those respective rates as well. And for a long time, life insurance carriers were arguing that these interest rates that we're supposed to assume in our products, they're really high for the current environment. They don't reflect the low interest rate environment that we find ourselves in. And again, so life insurance carriers were really lobbying that Congress would make some changes to that. And so what happened, kind of as a last minute thing with the omnibus bill that was passed at the end of last year in December, was that within, what we call that stimulus package that so many of us, refer to, within that stimulus package, there were some 7702 updates that allowed carriers to now assume a lower interest rate in their products. So you can see, for instance, that CVAT test that was formerly built at 4%, now gets lowered to 2%. And again, the Guideline tests were lowered as well. Well, Andrew, I get that. What does that mean? Explain that in layman's terms. Here's how it basically breaks down. It means Guideline limits will increase. What that means is that there's now going to be more premium that can be paid into a policy and still qualify as life insurance. So, for example, if I was max funding a VUL, an IUL, it's even going to affect whole life. So think cash value products. The premium that I was paying before under the old 7702 guidelines, I now, in those policies, if we were to, issue those policies today, we could actually put in more premium for that same amount of face, right? So, down below there, what it's saying is same amount of premium can be put into policy with a lower specified amount. That means that if you were solving for a minimum non-MEC scenario, that minimum non-MEC face is going to be a lot lower. That's a plus for the consumer, because what that means is more efficient cash value in these policies. It means I can put in more premium if I want, or let's say that I know the desired premium I'm going to have. It means I can now have a lower specified amount, a lower face amount, which is going to achieve better cash accumulation. That also means lower charges for the consumer, right? Because if my cost of insurance, my COI charges based on that face amount, if that face amount is now brought down, that means that I have lower charges. Again, that's going to equal better cash accumulation for the client. So really what 7702 has brought about this year for life insurance carriers is more attractive cash value products. Now, those products didn't immediately hit the ground running on 1/1 of this year. Carriers have until the end of the year to adopt this, and that's what you're seeing in the industry. There's some carriers that have already made their 7702 changes. We at North American are making our changes here at the end of May. And you're going to see that continue to roll out in the industry. Like I said, carriers have until the end of the year to adopt this. This applies to all policies that were sold this year. So if there was a policy sold in January and the carrier still hadn't made the 7702 updates, that policy can be grandfathered in. And so I think what you're going to see here is carriers come up with creative designs to roll out the 7702 changes. One thing to keep an eye on, though, is how that impacts target. There's a lot of questions surrounding that. Of course, when the face goes down, since target's tied to the face amount, you're going to see some changes in target. And I think that's going to be interesting to see how we as an industry kind of balance that out. But again, to give you a brief update on what the 7702 changes mean, how that impacts cash value life insurance. I also briefly wanted to move on to some things that I think is important, but that's potential tax changes that we might see either in 2021 or with this current administration. Right now, where we find ourselves today, right, we know that 37% is a top tax rate for individuals. You can see the amount that would apply to joint filing there, a little over $628,000. And one thing to note is capital gains differ from wages today. So a lot of you working with clients and investments probably already know that and how that impacts clients in a favorable way, right? That capital gains tax differs from traditional, income wage tax. Now, the proposed Biden tax plan would increase that top individual rate from 37% to just under 40%. Perhaps more importantly, is the threshold to get into that highest tax bracket would be lowered from where it's currently at to what we're hearing today is that no one over 400,000 would pay higher, but we know that those certainly filing jointly above that would be impacted. We're also looking at a higher alternative minimum tax rate, possibly a tax on investment income over $1 million, elimination of the carried interest loophole, decline in 401k deductions, which would actually impact those contributing the highest amount who can benefit from that today with the proposed Biden tax plan. That could really impact them. In short, what I'm getting at here is that we could see higher individual tax rates, more to come, right, on where Congress lands on this, what exactly is the top rate ends up being, what the thresholds are. Are they going to stick to that 400,000 amount? Is that going to be a moving target? Again, more to come here, but I think the moral of the story is that we're likely going to see an increase on individual tax rates. Moving on to another thing that's often talked about right now in our industry is what's going to happen to the estate tax rate, right? Where is it at currently? We know that 11.7 million is a current estate tax exemption on individuals. It's a 45% tax on estates above that, and there is a step up in cost basis, which really benefits those. If a spouse passes away, or some situation like that, to be able to absorb that and say, my cost basis just increased. That's really beneficial to a lot of people with large estates who are looking to transfer wealth. But we know that at least, when President Biden was, prior to him becoming president, when he was on the campaign trail, what he proposed was what you're seeing here, and that's at 5.85 million estate tax exemption, right? So that'd be a big decrease in the estate tax exemption and the elimination of that step up, which is, like I said, that's really huge right now. A lot of people take advantage of that. So eliminating that would be, really impactful on people whose estates would fall into this category. But what's even maybe more troubling is what we're seeing Senator Sanders has proposed, and I believe this bill that he set forth is called something like for the 99.5%. I believe that's the name of the bill that he presented in the Senate. Now that would decrease the estate tax exemption even more than Biden had proposed. That would be 3.5 million. That would be a huge change from where we're currently at 11.7 million. In addition to that, while President Biden said, he would keep that 45% tax, even though he's eliminating the step up, what Senator Sanders is proposing is that we would have progressive tax rates on estates, generation skipping tax, enhancements there. GRATS valuation discounts would be done away with. GRATS would basically, essentially be eliminated under Senator Sanders' plan. So a lot of wealth transfer tools could be impacted. Again, the moral of the story here is, what's going to happen with estate tax. The exemption is likely going to go down, and possibly the estate tax rate will likely go up. Again, more to come on that. But all that to say that I think that with the 7702 changes, with cash value life insurance getting better, possible tax changes or tax increases coming down the pipeline with the current administration, that lends itself to life insurance planning opportunities. And in closing here, I just want to highlight just a few opportunities that I envision throughout 2021. The first being with 7702, enhancing cash value life insurance. I really think this is an opportunity for retirement planning. If you're an advisor and you're working with clients who maybe are high income earners, or maybe they're not well diversified, you can see here, how many clients, when you sit down with them, do you have the conversation of, are all your eggs in one basket? Where are your retirement funds? Are they all in a taxable account? Are they all in a tax deferred, which are probably where the majority of dollars are in a tax deferred account? How many dollars are actually sitting in a tax free account for that individual? And if we find ourselves where we do today at historically low tax rates, with perhaps looming tax increases and 7702 making cash value life insurance advantageous, that could be an opportunity to have that conversation about funding something like an index universal life policy for supplemental retirement purposes. The second opportunity I see is really in that estate tax or estate planning arena, right? Where we know that there's probably an increase in estate tax rates. What does that mean? Again, here's just an example highlighting what a $1 million liability would be for a 6-year-old female. Would you rather pay all that out of pocket from your estate, or use life insurance to leverage that? And you can see here, assuming this 6-year-old has a life expectancy 85, how much of that would actually be out of pocket versus how much does life insurance cover? Really simply put, life insurance gives you leverage and is tax advantage. And lastly, I think living benefits is another opportunity we see today, especially in light of COVID. How many people look around, depending on the state, and just look at the number of deaths of people that were in nursing home. I think a lot of people post-COVID are saying, you know what, I don't want to end up in a nursing home. I need a policy that has living benefits that I can tap into should I become sick. Again, these are things that we can spend a lot more time diving into, but really my hope today was just to highlight some of the changes, regulatory changes that are existing today, how 7702 is making cash value life insurance more attractive. I really think what this means for your clients is that, with the advantages of 7702 and the perhaps looming tax increases, this is an opportunity to put your clients in a better position and to have that conversation and to have that planning. My hope, again, is that in tuning in today, that you've just got a few nuggets you can follow up with E4 on. Reach out to them. They'd be happy to have conversations in depth about the things I've talked about. And if you need any help with illustrations or product material, they'd be happy to help you with that as well. So again, thank you for the time. Abby, I'll turn it back over to you.
Thanks, Andrew. Great debrief on all of the changes happening in our industry. Much appreciated. I've opened up the line for any questions. If you guys have any for Andrew.
Hey, Andrew. Thanks for sharing.
Hey, Dan.
Just one of the things, I've been having some conversations, and one of the challenges when you're talking about 7702 and we talk about the ability to put more cash in, one of the natural questions that's coming up from CPAs and other advisors is, well, what's the limit? Even clients say, what's the limit? And that's the beauty of this, is that there really isn't a limit. The limit, the test is really around how much death benefit do you have to have for the amount of premium that you're putting in. But there isn't a limit like you have with Roth contributions and other things. So the client can really put what they want in. And that's an interesting side effect when you start talking about that we've got this new supercharged life insurance contract that can actually build, it's more efficient after 7702 changes. The next question is, well, how much can I put in? I just find that to be an interesting aside when people start to get it.
Spot on, Dan. There's no income limit, right? There's no limitation. There's no limitation on the amount I can put in. I have no 59.5, early withdrawal penalty. So all those limitations we find often in qualified plans, you're absolutely spot on, Dan, that with life insurance, we don't have that limitations. I can fund that as much as I want to the ability that I want to, have tax deferred growth and take income tax free.
Great.
Any reaction to Dan and Andrew share their audience? We've dazzled them. This from the audience: is North American considering any SUL products, survivorship universal life?
Yeah, so great question. We actually are. I myself am on a committee that's working on future products for North American, and we're very heavily looking at a SIUL product. So more to come on that, but I'm hoping that's something that is in our near future, especially what I talked about. If you look at what's going to happen possibly with the state tax rates, I think that a survivorship product, would have a lot of potential in that market.
Great question, Ed. Thank you. Any others? And for those of you that perhaps dialed in late, we do record Brewcast, and this will be put up on our YouTube channel this afternoon as well. So if you want to watch the replay, it'll be there for you. Let's go right to the drawing, Andrew. I'm going to have you draw a number between 1 and 24, sir.
12.
12. It's a number. Who's the winner? Who's the winner? Bjorn Nesvold, congrats, sir. Be on the lookout for a complimentary coffee card and CE credit coming your way from all of us here at E4 Insurance Services. And be sure to tune in next week. We'll have E4's very own wealth strategist, Bill Anderson, discussing cylinders of money, a fan favorite, discussing life insurance as a retirement plan. Thanks, friends, and make it a great day.